the question is, how should I invest my money? The move to passive can cause, with all the ETFs and everything else, can cause dislocations in the short term because people are not discerning. Each company, remember I said stocks are not pieces of paper that bounce around that you put Sharpe ratios and Sortinos on. Their ownership shares of businesses. And businesses, there's a dispersion in their fundamentals, how one's doing versus another. When you just take an ETF and don't discern between the differences in the fundamentals, that can cause dislocations in the short term. That just makes me smile more because those dislocations mean, hey, I can find bargains because people stop thinking. But I don't think they're at such an extent that other than in the short term, I think you're familiar when the market falls and everyone gets depressed all at once. They say correlations go to 1. That just means everyone throws the baby out with the bathwater. They don't make no discernment. But that really just happens for the first month, maybe 2 at the most, and then there starts to be discernment. That's actually the best opportunity time for us. When people start discerning again and you just had everything move together, which it shouldn't. They all have different prospects. And so the same with ETFs, if there's flows into them or the indexes, that could cause short-term dislocations over a month or 2, but those get corrected over time. Like I said, the market eventually gets it right. There's a lot of, if you just think of the jelly beans, you really get it. It's the jelly bean effect of when everyone hears what everyone else is thinking. That happens most of the time. That's what the stock market is. Your job is to be cold and calculating and unemotional. Unfortunately, people are human. It's good news for us. But people, the stats are against you. That's why I think the indexers get it right for the wrong reasons. They mostly are saying the market's efficient and have other explanations of why you can't beat it. I think the market often gives you opportunities, but it's very difficult to take advantage of them for behavioral and agency problems. And those are much more powerful than you would think by just saying, oh, behavioral and agency problems. The people are people, and it's been happening forever. I don't think it's getting better. I think time horizons are shortening. There's so much, all that data, look, when I started my first firm in 1985, I used to write quarterly letters, and they read something like this. We were up 3% last quarter, thanks a lot. That's what it sort of said. Now, we have $10 and $20 billion endowments that need to get our results weekly. I don't know what they do with them, but we now have to do that. Most of them do a good job with it, but that's just the way of the world. So if you keep measuring things in shorter periods, and you can measure them, and there's more data, it doesn't make it better. It makes you more susceptible to emotional influence. So that world's getting better. The last man standing is patience. We call it time arbitrage. Other people call it time arbitrage. Just being patient. That's in really short supply. It's not getting better. Things are moving to faster and less patience. So that's really the secret.